Hey everyone, Dan Hussey here, bringing you an update on positions, trades, Elliott wave counts, and some measured moves for March 1st, 2012. Before we begin anything, the trend remains up until it's not, and we're going to remain bullish this market for the extended period of time. So I actually have up here a count of the S&P 500 that over the last 2 years, I came up with this count back in 2010, and back then we kind of laughed at it. But it's actually looking like this count might, in fact, be the winner. And when you step back and you take a big weekly chart of the S&P 500, uh, this three-wave correction down, not from all-time highs, not from the all-time highs back in 2007, but the 2000 top that resulted in our first recession, major recession, which was accounted for by the tech boom, rather bust. You had the tech boom and then the bust. Um, that first wave down, it looks like a wave or potentially a W in a complex or not a complex correction, but a flat correction, where the market pushed to new highs in an A, B, double three or triple three B wave, and then a very clear five wave pattern down in C's down to the what I think we can now call a generational low at the 666s. Now, if you were to draw a Fibonacci pole from lows, as far back as you can go in this market, in theory, just put them at zero, because back in the 20s and there was a time in this market where we were trading around $10 for the S&P 500, and so effectively just throw it down to zero, because on a logarithmic scale we're already 2 powers of 10 higher than that. So it's effectively put your fib at zero, draw it up to your all-time high, and we failed to break a 61.8. We filled a 50%, which comes in right about 100 or 800, and we failed to break a 61.8. And that pole, which we'll show you in Thinkorswim in a bit, has targets, new all-time high targets up in the 1900s. And it is certainly looking like this flat is playing out, as I can count this rally off the lows, as much as a lot of people don't want to, can count it as three or five waves, and then a three-wave correction. It yet to be seen if the three waves we have off of our lows in 2011, if we're going to continue higher here, or if this is too going to be a correction, we'll see a dip down again. I don't believe that's the case. I think we're seeing some real growth coming out of the U.S., a lot of different things happening. Basically, a lot would have to happen fundamentally for this market to break down. We're not a fundamental trader. I'm not a fundamental trader, so I'm trading the trend, and we're going up until we're not. So from an Elliott wave perspective, to me, it looks like this market has completed a major pullback from a weekly standpoint, and then from a daily standpoint as well. In 2011, I believe the lows we had there, I don't believe we'll see those lows potentially ever again. So we'll see. Well, at least not for another generation. Okay, so moving on, the euro dollar. A couple things to look at. We used to look at in my when I was with Impulse Traders, we used to look at correlations in the marketplace, particularly between the euro dollar. I'm sorry. Back to the S&P for one moment. Let's look at. I had a question on Twitter to take a look at the S&P 500 and what it looked like when crude. What it looked like in comparison to crude when crude rallied to its all-time highs. And I have that chart for you here. So this is a weekly chart of the S&P 500, and you can definitely see the correlation. Crude rallies, S&P's rallying. Crude sells off, the S&P sells off. It's risk on, risk off. The October highs in crude in the 145 up in the 140s were a few months before the market top for the S&P. However, it is clear as a bell after the 666 lows that these two markets have not diverged, not one little bit. Both crude and the S&P 500. The S&P 500 is actually leading the way here to the upside, which we expect. The S&P 500 here is, the S&P 500 topped before crude did. The S&P 500 is gold, and crude is the color, or the other darker colored bars here. So the S&P 500 clearly leads as it tops, not once, not twice, but just about every top and bottom has been led by the S&P 500 in crude. Your highs here at $38 a barrel. Crude made a high half a year before that. Highs in the S&P 500 in October of 2007. Crude tops in July of 2008. However, they've been more tightly correlated now than ever before off the 666 lows. So those that believe, crude is, can't rally with the S&P, or S&P can't rally with crude, it's just not true. You look at this market, the correlation's there. It's clear as day. It's been true for decades now. Don't believe just because for a couple weeks here we've seen the two diverge slightly that's going to hold, because it's just not, in my opinion. Okay, now to the euro. Looking at some of the correlations, obviously crude and the euro, there is a correlation somewhat. You can see how it dips and rallies, but for the most part, the euro has kind of broken many of its correlations with markets right now. You can see that now, and this is an hourly correlation chart or overlay of the S&P and euro. Before the start of this year, the two diverged immensely. You can see how we're not even showing up on the overlay of where we are in the current ratio. Sorry, we're loading here. I probably shouldn't have dragged it back that far. Nevertheless, the point being is that their correlation has come back in the start of 2012. And, the beginning of every month, we look for slight divergence in that. And we're seeing that. And I think, we have to anticipate it coming back. And you can definitely see, though, that the S&P leads the euro. The sell-off here in January, the euro was a couple days late to the party. The rally, S&P found a low January 30th, crude not until February 6th. Again, the sell-off and lows, they correlated together here. But now, it's pretty clear that the S&P is now leading the way to the upside, which is precisely why we have to have strong considerations to, if you're going to play this correlation, to buy the euro as you believe they're going to converge once more. Gold in the euro, this trend comes and goes, but certainly the sell-offs were correlated in a risk-on, risk-off way. And of course, our euro primary now. And this is a weekly chart. All my Elliott wave counts today are going to be long-term, because when we get down to it, Elliott wave just simply works best the bigger the time frame you can get it on. Unbelievably, euro looks like it has set up in a massive wave 2 from all-time lows at the 80s to all-time highs in the 60s, 160, and has held a halfway back of that pull at the 121s. We failed to break it at the 112s. This long has a target at the 178.80s. So we're talking, thousands of pips higher. And of course, it's a weekly long, so we're not expecting this to happen overnight. But I want to show you that back in 2004, the euro had been trading in a series of extensions that it started to hold once, twice, and it, of course, rallied up to its target at the 161s. Well, the target was the 46s, but it continued on and went to its secondary target. So this market has a very bullish long-term setup to begin with. Not to mention, This pattern right here on a chart looks like an inverted head and shoulder. Left shoulder, right shoulder, head, and you can expect the rally up to on a break of the neckline at the 149s, another 1,000 pips higher to the $6.60s. So to me, it is looking like this market is getting a setup that it could potentially take to new all-time highs. And it has the counts, it has the pull. Everything looks very bullish on a long-term time frame for the euro. And someday, when we are pressing up higher, other people, you got to remember we are coming off a low, a big low here. So you have to anticipate people are still bearish, and they're going to remain bearish until we're at the top. There is a group of people who will sell this market the whole way up and be wrong the entire way, and you just have to ignore it and trade the trend and follow what your eyes see, not what you think. Gold, oh man, my personal belief that in 2011 we had a big wave 4, and we have entered now a wave 5. Gold has a tendency to pull all the way halfway back for the year, and we'll take a look at what that looks like on a chart in a minute. But the count is there, and I think we're going to new all-time highs. I don't even think 2,000 is gonna be a stopping point. I think 2,200 to 2,500, and we'll take a look at those in a second. Dollar yen. It looks like we have completed a major cycle. We have a nice weekly and daily reversal, and there may be a potential here to actually reverse and get long. Now, the dollar yen, until the Fed really starts raising rates, it's going to be slow to start and carve out a bottom here. But if it does choose to do so, we're going to be probably looking to get long for major swing trades, particularly if the Fed's dovishness begins to pick up, because the dollar yen will be the first currency to respond to any interest rates. And last but not least, the Kiwi. On a weekly time frame, it looks like it has completed a B, C flat. Is continuing higher in a two-nested 1-2 count, very similar to the Australian dollar as well as to the S&P 500. So I believe we could see the Kiwi to parity, on its next major rally higher. All right, so enough of Elliott Wave. Let's take a look at, we haven't taken a look at this chart or these charts in a while. This is what I call the big board. It has your U.S. dollar crosses on the top, beginning with Euro, Aussie, Pound, CAD, the Swissy, and then the U.S. dollar index, which is a bona fide inverted euro. And you can see that dollar rallied strong, over the last week, but in reality, the move was only seen in the dollar franc and the euro dollar. Now go down to the yen crosses. Those two charts, again, also look ideal. So what you're seeing here is the dollar's only strengthened against the Swiss and the franc, whereas against the CAD, or against particularly the CAD, the pound, and the Aussie, it's weakened significantly and hasn't broken any major trends. Now there seems to be a very good reason for this, and we'll take a look at it in the measured moves in a second, particularly for the euro. But trend is still very much down for the dollar, and trend is up for risk. And you take a look at our markets, and risk appetite in these markets is very strong still. So let's begin.